Hi, everyone. This is Jason Burack of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a returning guest. I had them on about 3 months ago. They are way ahead of the curve on their insights. They were predicting the food and energy crisis, I think 12 months ahead of pretty much everyone else. They have a very large Twitter following. Doomberg, thank you for joining me again.
Jason, great to be back. Really enjoyed the first visit, and I know we're going to have a rigorous discussion this time because the news flow is giving us plenty of meat to chew on for sure.
Yeah, our last interview, for the listeners who want to go up and look it up in the archives, I think was on April 1st. And so it's only 3 months, but so many different things have come out in the headlines with the food and energy crisis. And yet the commodities markets have just had an enormous sell-off. It's a big dislocation from what we're seeing in the headlines and what you've been covering in the articles with what's going on in so many different emerging market countries with protests over food, energy, electricity, diesel, pretty much anything involving food and energy that these politicians and bureaucrats have screwed up.
Yeah, it's really amazing to watch we were having a little chat before we hit the record button, the disparity between the paper market and the physical market, especially in the energy sector. Our contacts in the energy space report no loosening of conditions whatsoever. Demand is still strong in North America, and but it is what it is. One of the reasons why we hesitate to trade commodities and futures is because they're so volatile, and sentiment plays such an important role. And who knows what governments around the world are putting their thumbs on what scales. Not to be conspiratorial, but if you think that national interest isn't expressed through at least some of the most important commodities markets, you'd probably be a little bit naive. So nonetheless, we sort of, as you know, take things from a fundamental geopolitical / macroeconomic level and resist the temptation to try to call market swings. Although I would say, as much as many of the commodities, including the ag markets, have been just face ripped here in the last week and a half or two, we don't see much in the way of reality on the ground that would justify coming off the top so hard. So it is what it is. Interesting to watch for sure. But no shortage of doom in the world for us to chronicle.
Well, here in the US, you have the November 2022 congressional elections coming up. You just have a bunch of, I would call them desperate policies by the politicians in power, the Biden administration, Congress. They're selling strategic petroleum oil. There's been a number of different articles coming out over the last couple of months, whether that's from oilprice.com. These are credible energy journalists from Reuters. These are not just journalists from one side of the political spectrum. And they're reporting that strategic petroleum reserve oil is being sent to the European Union, is being sent to China, that diesel and gasoline are being exported. So Americans are not benefiting from the US energy sector, which on a relative basis is still better than pretty much any other energy sector. We have our politicians and bureaucrats sending this stuff, this valuable energy, to their friends, the Davos crowd in the European Union, and for political kickbacks to China.
I have a slightly different view on that. And I read those stories, with U.S. refineries operating at 94% of nameplate capacity. Releasing oil from the Strategic Petroleum Reserve is the sin. Where it goes is just the natural way in which the globally traded oil market works, in our view. So in other words, if you look around the world for where there exists spare refining capacity to convert that oil into gasoline and diesel and other products that are, serve as inputs, say, for the chemical industry, for example. There is no excess refining capacity in the U.S. We wrote a piece called Grim Diesel that chronicled much of this a couple of weeks ago, maybe a couple of months ago now. And so it is a bad headline. It is a bad look. We don't think that the U.S. should be releasing oil from the Strategic Petroleum Reserve when the domestic refineries are operating at 94, 95% capacity, because we don't have an oil shortage issue in many ways. We for the particular prices the Biden administration is desperately trying to bring down, i.e. gasoline and diesel at the pump. The real issue is bottlenecks on the refining side. And all you're doing when you flood the world with the Strategic Petroleum Reserve is you're fattening the profits of these refineries. And most of them are very hesitant to invest, of course, because of the environmental policies of the administration. So it is I understand it's a bad look, but if you don't, to look into the nuances of how the global oil market actually works, it's not surprising to us. And in fact, the government couldn't really control where that oil ends up after they release it.
Yeah, unfortunately, they shouldn't be releasing it all. And do you think at some point they're going to have to, obviously, they're going to refill the Strategic Petroleum Reserve in the years to come, but that's going to take many years, and it's going to be at much, much higher oil prices in the future.
It's not sure to me that they will. These people live in a world where they think that society won't be needing oil, and now is as good a time as any to get rid of it. Honestly, that's the level of sophistication of some of the key policymakers in the administration, in our view.
And yet they're begging, and yet Biden is going on trips to the Saudis. He was begging the Venezuelans. So there's all these policy decisions, these energy policy decisions that don't jive with each other. They don't make sense, because here they are dumping the Strategic Petroleum Reserve oil instead of focusing on long-term supply solutions here in the United States. And then they go to the Saudis, who don't have any spare capacity really at this point.
Yeah, that's a real fascinating thing, and I'm not sure when this will publish versus when Biden's trip, which is tomorrow. We're recording this on Thursday. The outcome of that trip is going to be fascinating to watch. Everyone just assumes that Biden wouldn't be going to Saudi Arabia if he didn't already have a deal cut. We have a different punch. MBS is a interesting character and might relish the opportunity to embarrass Biden by sending him away with nothing. I think much of the weakness in the oil market in the past 10 days or so can be traced back to the market's belief that there must be something up the sleeve of the U.S. administration, and something good vis-a-vis supply will come out of this Middle Eastern trip by the president. That's certainly the consensus view. Let's call that 80% likely. In the 20% camp is the view that MBS is going to embarrass the president, and that would be quite the fiasco if it happened. And you'll note that I believe it is a junior politician is greeting Biden at the airport, not MBS himself, which contrasts with who greeted Trump when he went to Saudi Arabia, of course. And so those are little signs that you see that might indicate that perhaps a deal is not baked. Normally, administrations will never let the president go somewhere like this in such a high-profile way without having such a deal, which is, of course, why the market is discounting that one must be occurring. I would say, and we would say, keep a close eye on the headlines coming out of Saudi Arabia. Look through the spin and see what the reality might be. Because if Biden does leave there hat in hand, an empty plane on the way back home, look out above for energy prices.
I've also been seeing all these article headlines coming out lately, whether it's from the International Energy Agency in Europe or elsewhere, that there's going to be either now or in the very near future demand destruction for gasoline and diesel. Do you see that, since you talk to a lot of contacts in the actual businesses that use energy, diesel farmers, other contacts?
Yeah, so let's remember that demand destruction is a euphemism for punishing poor people. Energy is life, and those who can least afford it are the first to turn off their access to it. And so I hate the phrase demand destruction because of it's just this sort of neat sounding euphemism for imposing harsh conditions on poor people. And so, yeah, I mean, not yet big signs of a slowdown in demand for oil. Don't forget, everyone's modeling, 100 million barrels a day type consumption. We have an enormous number of people ascending to the middle class in the developing world. As sort of GDP per capita continues to evolve, there's a step change, an S curve almost, to borrow a terrible phrase, in demand for energy as these economies evolve from, say, second world to first world, to use a bit of an old vernacular here. And there's, we just look across the emerging middle class of China, India, Indonesia, pick your favorite Southeast Asian country. These people get accustomed to the standard of living pulse increase that a shot of energy gives you. And, we're going to need a lot more than 100 million barrels of oil a day over the next 10 to 20 years. And it's not clear based on these capital investments that the industry has been avoiding and not making in the past 4 to 5 years, where that oil is going to come from. And so, there's I think oil has to go a lot higher to see quote unquote material demand destruction. Could be wrong. Others believe that the top is in, and if the top is in, all that really means is that the economy is entering a deep and severe recession. So pick your poison.
So to add to your points there, I think there's only been about 3 or 4 years out of the last 15 or 20 years where oil demand, gasoline demand globally actually fell. And it was only for about 8 to 12 months. So it was not over multiple years. So I think one of those was 2008. Another one was 2020. That wasn't free market or capitalism. That was politicians. That was politicians and governments shutting down the economy. And then we had a very sharp bounce back in demand for oil, gasoline, diesel. And we had supply problems because so much natural gas supply and oil production had come offline starting in the first quarter of 2020.
Yeah, and it's true. Left to their own devices, the world will orient their economies around higher energy return on energy invested fuel sources. And absent nuclear power, which is complex and technologically challenging, the next leg down, it's a steep leg down, but it's a much higher up on the ladder than, say, intermittent renewables. The next leg down is natural gas, and then oil, and then coal. And historically, economies climb that ladder. They go from burning wood to burning coal to burning oil to burning natural gas. And that's a sort of a foundational momentum of human development that is, I think, irresistible, impossible to bottle. And when they do succeed in trying to impede it, you end up with situations like we published on this morning, which is this humanitarian fiasco, this disaster that is unfolding in Sri Lanka.
And it's not just Sri Lanka, although everyone's seeing the videos now online on Twitter with the presidential palace. And I think, didn't the president, he fled with a duffel bag? Was it briefcases or duffel bags of cash? He already fled the country. What's the old joke about like Nigerians or Venezuelans with briefcases and duffel bags? Although Sri Lanka is not an oil producing country, so it's not the oil profit theft. But unfortunately, it looks to me, Doomberg, like there's going to be a lot of this, and emerging markets are going to take the brunt of this, especially since we're seeing these oilprice.com articles that a lot of this liquefied natural gas that would have went to emerging markets to give them relatively cheap energy prices. Instead, it's being diverted to the European Union. So,
yeah, this is a big challenge for the rest of the world. You compound that with this enormous bull run in the dollar, which is basically de facto exporting inflation to the emerging economies. If you are a net energy importer and you have a domestic currency and you have to settle your current accounts in US dollars, because that is the global, the trade currency for oil and gas, you're in a world of hurt right now, with DXY mooning like an altcoin. And people talk about the sort of collapse in energy prices we've seen in the past few weeks. Last I checked, $95 a barrel oil is relatively expensive in historical context. For the better part of decades, oil was bounced between $10 and $25 a barrel. So at $100 oil, let's just call it sort of round numbers, and the dollar on this epic bull run, people with trade deficits that need to be settled in hard fiat like the US dollar or the euro, pick your favorite, although the euro is getting weaker by the day here, they'll be the first dominoes to fall for sure.
And we're recording this interview on Thursday, July 14th, 2022. The dollar index is above 108. It's at 108.63. So it's still rising. A lot of that, though, is because of the weak euro, because of a weak Japanese yen, which makes up the dollar index. But if you're an emerging market country and you have all these stress factors going on with high energy prices, food problems, you don't have a lot of US dollars. Sri Lanka, and you could talk about this, Sri Lanka got in trouble because their politicians did not save up enough US dollars. They were not running trade surpluses to save dollars for a rainy day so they could go and import food, staple crops, or diesel, energy, other key imports, they didn't have the dollars to go on international markets or negotiate with other producers to go and import the key food and energy that they needed. And I think a lot of emerging markets over the next like 6 months, as long as these factors continue, they're going to have similar problems. We're seeing what videos now, not just for Sri Lanka, although Sri Lanka is further ahead on this. We're seeing what protest videos for, I think, Albania, Bulgaria, Ecuador, Macedonia, and that's just, and I also just heard from listeners, I did another show on this a couple of days ago. I think there's protests now in the streets of Panama and other countries as well.
Yeah, Armenia, you name it. And Sri Lanka is a bit of a special case, but in a way, it is an even more dire warning to our policy makers in the West. Sri Lanka embarked upon a disastrous and rapid pivot away from modern industrial farming techniques and towards quote unquote green organic farming techniques, to the point where the president of Sri Lanka banned the imports of chemical fertilizers, and it only took one season, as you can imagine. The inventory of food in the world, or in this case, in an island nation, is finite, and they messed up one season, and society collapsed. I mean, they are in the hurt locker. It's sad to see what's going to happen there, because, by the way, we're just at the beginning of it. I mean, we don't see a global, a global move to try and bail out or help Sri Lanka from any of the sort of Western countries. At least we haven't seen it. And if they don't get on that pretty soon, there's going to be a mass migration event there. We likened it to passengers brawling it out in the banquet halls of the Titanic. I mean, their fate is sealed, absent massive intervention that we just don't see on the horizon. And so the whole point of using Sri Lanka as the opening to our piece, which is really a warning about Germany, was to show just how quickly society collapses in the absence of primary energy, because fertilizer and food, of course, are just derivatives of energy, albeit very important ones. And one terrible policy blunder layered on top of years of corruption and grift and all of the sort of standard things that you might apply to a place like Sri Lanka. Snap of a finger, literally overnight, it went from a pretty good country to a complete calamity. And we were a little provocative in this piece that we put out this morning, called Running from Empty, because Germany, when you look at it, they might have a wider buffer between themselves and the abyss, but they sure seem to be on a similar path.
Yeah, Germany wasted a ton of resources trying to do wind and solar. They shut down their nuclear power plants. I'm not sure if they're going to restart those. They were talking about importing coal a couple of weeks ago. Their energy policies, a lot of it's because of ESG and dependence on Russian natural gas. A lot of it's a mess right now.
Yeah, they're in a real bad shape, and their electricity prices are just enormous, and no industry can survive the types of massive run-ups in something as foundational and fundamental as electricity. And Germany, which is a sort of prides itself on being a value-added exporter of finished goods, reported a trade deficit for the first time in decades in May. And their year ahead electricity costs, which is the true benchmark for how power suppliers, power producers, their inputs and things like that. That number is up ninefold from like 2 years ago. It's just really crazy. I'm just pulling up the numbers as we're talking. Yeah, it's off a little bit from the highs. So let's say 2 years ago, you might be able to book, forward year specific baseload power for $40, 40 euros per megawatt hour. Now you're talking 350 to be precise.
And that type of increase is going to destroy profit margins. Well,
no, I mean, it's literally going to shut businesses down. We put out a piece describing, BASF's challenges at its Verbund site in Ludwigshafen called More Verbund. And that's more of a natural gas play, but the natural gas is used to make power and industrial steam for that super site. I don't think Europe can withstand the smash that is coming and has already really arrived to the German manufacturer, which used to be a powerhouse and is now, I think, in some real pain. You cannot increase your baseload power costs by a factor of 9 and not have that just destroy your economy. And as look at the world is watching, on July 11th, Putin closed Nord Stream 1, which is the main artery through which Europe has been receiving natural gas from Russia, even throughout this war. They closed it down for quote unquote maintenance. There is a geopolitical battle with lots of intrigue about some parts that Siemens was having repaired in Canada, and now Canada is, holding on to those spare parts, and Russia seems like they're not going to start Nord Stream 1 until the Canadians relent. The Ukrainians are opposed to the Canadians relenting. It's a mess. If Nord Stream 1 does not come back on, you're going to see panic in Germany, and it's going to be an incredibly tough winter. We've been writing about this for, as you mentioned in your intro, for the better part of a year. People criticize us for pointing out just how much geopolitical leverage we gave Putin, as though somehow pointing that out and suggesting that we perhaps shouldn't is unpatriotic or pro-Putin. It's the opposite. We would like for our geopolitical strategy to be successful. Here's the way to do it. The path we're on right now is it's idiotic, and it's going to result in either Germany flips and becomes much more in the Russian camp, or Germany freezes. And we shall see. We watch with bated breath like everybody else.
They're already rationing electricity there, right? For air conditioning.
Yeah, they're doing all kinds of things. But honestly speaking, we know some people in Germany and reached out to contacts there. And from what they tell us, reports on the ground are people are sort of blissfully unaware. It's not in the news. It's being papered over. It's not a big deal. Life kind of goes on. We suspect that if the doom scenario plays out, it's going to come as a massive shock to the sort of average citizen in Germany.
So if Germany's not exporting, then wouldn't people eventually in the near future start losing their jobs? So if people are blissfully unaware, as you said, eventually it's going to hit their bottom line, their finances, if they're going to lose their jobs because their businesses, their exports are going to stop. Yeah.
So here's the thing. Of course, the unions have a lot of power in Germany, right? And so you'll see several quarters of not only compressed margins, but even negative margins before a company could get its reorganization plans through the Works Council there. I've spent a lot of time in Germany myself, and one should not underestimate the power of the labor unions there. And in fact, to be fair, the labor unions in Germany, the unions themselves have been amongst the loudest critics and have been ringing the warning bell very, very loudly on the upcoming crisis. And that's why we wrote the piece that we wrote today, Running from Empty, because too few people see what's coming, and we wanted to highlight that for our subscribers.
Do you think then in the next couple of years that Japanese manufacturers, German manufacturers, do you think there's going to be even less supply available for a lot of consumers because of high energy prices? They're just going to say, we don't have the profit margins, we're just going to shut down, and that's going to exacerbate supply chain problems and create even less supply available for small businesses, the supply chain, and consumers.
So here's an interesting insight for those that may not have experience in the commodity sector. Actually, high prices and low volatility are fine. What kills integrated supply chains is massive volatility, spikes up and down, because people get offsides. The cash conversion cycle between when you have to procure your input and when you can collect the cash after its sale, in many instances, spans 60, 90 days. And so the real challenge for big companies like this, especially those that say take natural gas and convert it. Imagine you convert natural gas to fertilizer, let's say. You're procuring natural gas at a price. You're selling your fertilizer at a price. And if they swing wildly in opposite directions, it's only a matter of time before you end up, long the thing that's tanking and short the thing that's mooning. And a period of sustained high prices but low volatility that allows supply chain to reorient around the new price, where everyone can pass on, the feedstock cost plus enough to earn their cost of capital, is fine. But what you have today, take Europe, for example, Dutch TTF, this is the natural gas benchmark contract for natural gas in Europe. That thing has swung from $12 a year ago to as high as $70 in February to back up to $50 today. It was $25 before the Freeport LNG explosion occurred. Those types of swings. And by the way, just to benchmark people, natural gas in the US is like $6.57 a million BTU. So you're talking about natural gas being 7, 8, 9 times more expensive in Europe than it is in the US. And if you're a manufacturer of the same fertilizer in Europe, you can't compete because your competitor on the, off the coast of Florida is turning natural gas into fertilizer where their input costs are $6.50 or $7 and your input costs are $50. So you shut your plant down. And so it's more nuanced than just high. High plus high volatility is really what screws planners. Given enough time, prices can be calmly passed on down the value chain. But unfortunately, in this scenario, when you're running as tight as we are, very small shifts in supply and demand can send prices wildly gyrating.
So with natural gas swinging like that in the European Union, what does that mean for farmers then? Are we going to have even less crops planted? Are farmers going to take, I've heard stories anecdotally. After my interview with you 3 months ago, I had farmers reach out to me and some of them said they hedged at lower food prices and then their input costs were still rising. Their profit margins were not good. Some of the other farmers told me that they didn't order fertilizer for a year. They planted a lot less crops. So we've seen this in the data that the crop yields were down according to the USDA, and that the amount of total crops planted were down. So how do you think that swing in natural gas prices is going to affect fertilizer and fertilizer prices and farmers?
Yeah, that's exactly the point, right? So some farmers are sophisticated, some farmers are lucky, some farmers pre-bought, others put off. Ultimately, it's the volatility that we're talking about here, right? Like if everybody knew that fertilizer prices were going to be at this price level, elevated, but would stay there, everybody can make smart decisions and not worry about risk management, right? But if you're a farmer staring down the barrel of when you have to apply your fertilizer, and you can either buy that fertilizer now or buy it later, you're basically a commodity speculator. And you know that the average speculator loses money, right? Nobody can time the market. And so we're converting.
But we need food.
Right. So we are converting procurement teams into commodity traders. And then, of course, in another little perversion of financialization, Wall Street hates it when commodity producers hedge either way because they like pure plays. So they like trading pure plays, punish companies that hedge. So, for example, if you were an LNG seller and you hedged 2 years worth of production at $10 per million BTU, you're looking pretty stupid today because LNG is anywhere between $40 to $50 per million BTU. You may have hedged that when the going price for LNG was just $5 a month before, and you thought $10 was a great price. You're basically a speculator. And procurement teams of manufacturing companies don't make for great speculators. And so back to my original point, to your question, the volatility that we're seeing is what's killing people for sure. So imagine, just take this recent decline in the paper price of oil. You're an airline and oil reached $120 and you panic hedged so that oil would not cost at least no more than $120 plus the cost of the hedge for the next year. Well, that hedge is now deeply underwater and you got to report that to Wall Street. And it's basically a real loss on your books, right? Because you're obligated to buy oil at 120. You might have thought that you were doing great risk management because you can at least assure yourself that you can afford to fly for the next year. That trade looks very stupid today with WTI at 96 and Brent at 97, whatever the price is closed at today. This is my point. Volatility kills you more than absolute price.
So it's the futures market, it's all this paper that's creating real world consequences for these businesses because they can't handle all the volatility and the price swings. If you're a farmer and a consumer, you want cheap food, high quality food. The farmers want to produce the food, but if their input costs are swinging like that, you're saying that they're kind of being forced to speculate, or they just sit it out. What we've heard from some of the farmers, they decided they weren't going to plant either as much or at all because they didn't want to play the game with the fertilizer costs, with the natural gas prices. So they sat it out for a year.
Yeah, and then don't forget their output revenues are swinging wildly too, as we were talking about before we jumped on, the recording. The ag complex has seen a massive pullback as well. So imagine you hedged your input costs, but you didn't hedge your corn or your soybean, assuming that those prices would still go up. Well, now you're stuck because you're paying a high price for fertilizer. Maybe you cut the top, and then you didn't hedge on the other side of your output cost, then you're kind of caught in a vice. And so, again, this all gets back to volatility of this historic nature crushes the small producer and big producers alike. And that's why you're seeing, for example, this nickel squeeze that happened in China. The world's largest producer of nickel got caught in a short squeeze, playing games in the futures market on the LME exchange. Basically got steamrolled by volatility. The world is filled with people that got run over by speculating in the futures market, which is, of course, one of the reasons why we don't do it.
But the important thing for commodities, though, is the real world still needs food. The real world still needs industrial metals to build things for electric vehicles or electrification, or to build homes or buildings. And then on top of that, you have oil demand. We didn't talk about this when we were discussing oil. I wanted to add this here quickly. The BP Statistical Review, which is like the largest single annual data points there for energy market usage, came out at the end of June. And it said that developing market oil and energy growth were actually the main demand drivers for gasoline usage, diesel usage, and oil usage now compared to the rest of the developed world.
Yeah, it's exactly right. I mean, it's pretty incredible to watch. Unfortunately, we were joking in the office today, like we picked a great time to start Doomberg last year. In our wildest dreams, we couldn't have imagined that it would have unfolded like this.
So we discussed the food and energy crisis in the 30 or so minutes so far, but do you think that there are other major risks to the global economy right now that are bigger than the food and energy crisis, or do you think that these are the biggest risks right now?
So I would say the resolution of the European natural gas crisis ahead of the winter is the single greatest crisis that needs to be resolved in the geopolitical sort of macro landscape today. And one of the markers that we're observing to see how that's going, of course, is the strength, or in this case, weakness of the euro vis-a-vis the dollar. Broke parity for a while today. It's sort of right at parity. This is going to be, the future of the European Union, and whether it fractures over, say, Germany cutting a deal with Putin. And one scenario we can imagine is Putin demands that Nord Stream 2 is how Germany shall receive natural gas, which would be a huge, sort of geopolitical coup for him. That might fracture the European Union. Time will tell. There's the UK sort of now outside the EU. So that's one situation that we think is huge. The other one that we think is a major risk to the financial markets, of course, is collapsing yen in Japan. There's a sort of war now, to be very, very clear, do not trade the currencies unless you're a professional and you know what you're doing, because shorting the Japanese yen has a nickname. It's called the Widowmaker trade, and it has that nickname for a very well-earned reason. People have thought for decades that the Japanese yen was going to collapse and have bet against it and have lost money. Having said that, the yen has radically depreciated against the dollar in the past several months. Broke out of a sort of a decades-long range from, let's say, 110 all the way up now to like 138, I think it was today. And to be honest with you, that move has been so pronounced, so vertical, that we're almost due for a pullback, which would lead to a rally in stocks. But that's the other thing we're watching. I just pulled it up. 139 on the close today, which is really just an incredible number. And if you look at the 5-year chart of the Japanese yen, it was range bound between, let's say, 105 and 115. And now it's just blown out of that range and is kissing 140. That's a severe weakening of the Japanese yen. The JGBs are under attack in the market. If interest rates spike in Japan, the Japanese government is basically bankrupt. I suspect and predict, and have predicted on Twitter, we haven't written about it yet, that the Fed might end up buying Japanese government bonds before this is all over.
Wow, that would be crazy.
We would call it international QE. Backdoor bail. Why? Because until this crisis, the Japanese were the largest buyers of treasuries. So it's all just one sort of laundering so they could de facto monetize U.S. deficits by having the Japanese buy it in return. The Fed would buy GGBs. That's too cute, perhaps, for some to conceive, but in the past 2 years, stranger things have happened. So just keep that in the back of your mind, Jason, and to your listeners. If you see that the Fed is going to put Japanese government bonds on their balance sheet, that's basically a de facto bailout of Japan so that Japan could still be the marginal buyer of U.S. treasuries, which is basically a backdoor way of monetizing the federal deficit.
With all the rules changes, backdoor bailouts that have occurred since 2008, 2009, U.S. dollar currency swap lines that the Fed has given out and then waived the loans later. At this point, Doomberg, with the rules changes and the goalposts moving, nothing would surprise me at this point.
Yeah, and the Fed has proven, if nothing else, that they will not let technicalities such as the law get in the way of whatever it is they feel like doing, which is, they blatantly broke the law during the COVID-19 rescue package, a series of actions, both fiscal and monetary, that transpired. The monetary part of that, including buying corporate bonds, is blatantly illegal. They just did it.
And they bought profitable companies like Apple, too. I mean, why are they buying corporate bonds for Apple when Apple's profitable?
It was a market signaling effect, sort of a Draghi, will do whatever it takes, and you better damn well know it's going to be enough. But the point is, one should not spend too much time reading legal technicalities when trying to predict what might constrain central bankers.
Well, if this continues, so if the dollar index rallies, the euro gets weaker, the Japanese yen gets weaker, we see all these problems in the Chinese economy is slowing down. And then the food and energy crisis, as we've outlined over 30 minutes now, it hasn't gotten better despite commodity prices, the futures markets in these commodity prices crashing. I mean, the real world, there's still all these problems with food and energy, especially. Do you see wide-scale collapse then for emerging markets trying to deal with a strong dollar and the food and energy problems then?
Well, that's why we wrote about Sri Lanka and we warned on Germany, because, as I said earlier, we believe the resolution of the German/European natural gas situation with Putin and Nord Stream 1 is the single greatest, look, it's a whack-a-mole of crises. And, just we're watching that, but we're watching to see what Biden gets out of Saudi Arabia, while we're watching to see if anybody bails out Sri Lanka, while we're watching to see if these bank run reports in China materialize into something bigger, which are happening coincident to, Xi up for basically permanent dictatorship here with the next party Congress. You're watching all these countries that have, let's talk about the Netherlands, right? And the farmers and the uprising in the Netherlands. This is right in the heart of civilized Western Europe here. There's no shortage of sort of cracking of the social norms and headlines that would have dominated the news years ago barely make a blip now because just so many of them. It's really, truly an amazing time to watch the news. And frankly, a bit scary. The name is Doomberg, and we write about things that are precarious, but at the same time, we try to be very optimistic people, and we would rather we didn't have so much to write about that we do, because I tell you what, we're 125 articles in, and there's no shortage.
Well, you kind of, as an investor, you kind of have to look at reality, though. So, yeah, it's nice to be optimistic. And if you're making a long-term investment, you want to buy low and sell high. So if you can get when there's blood in the streets and go in and buy a company that has a bright future and you can get it for pennies on the dollar, that's good. But it's also good to understand what's really happening. And what's really happening are these headlines with these emerging markets. And then also the problems in China. I mean, we spoke about the food and energy crisis. We didn't talk about all these things that have been happening in China. A lot of it's also happening in China they didn't have good crop yields for years now. Even prior to the pandemic, they've had lots of droughts. They've had lots of flooding in different areas of China, bad crop failures. They have to import an enormous amount of food. And then on top of that, you spent a good amount of time talking about German manufacturers. I mean, Chinese manufacturers, they're not doing value added like in Japan or Germany for their manufacturing, but Chinese factory owners, I've seen interviews with some of them, if they were even allowed to run their factory. So they've had electricity shortages for the last 2 or so years, almost 2 years now, where the Chinese government in some areas said you can't even run your factory for a number of days this week. And then when they did run their factory, their energy costs for diesel to to buy like a separate diesel generator, or their electricity costs were up over 5x. So they're getting killed with similar problems to what you outlined with German manufacturers.
Wow. I mean, China is deeply short energy, let's be honest. And so the LNG crisis that hit Europe washed on the shores of China rather quickly, and the JKM contract, which is sort of the equivalent of Dutch, the equivalent LNG contract for Europe, Dutch CTF that we talked about earlier. That JPM contract I'm just pulling up right now as we speak is it's $40 per million BTU. Like China is talking about lifting sanctions on Australian coal because they see this energy crisis coming. China is deeply short energy, and yet we allowed them to take over much of the manufacturing, next step up from energy manufacturing. And now they're in the hurt locker too, right? And so, and this is all transpiring while Xi is positioning for basically, in the regular order of the CCP's sort of leadership cycles, Xi would be stepping down, and a successor would be taking his place at the next Congress. And he is clearly not wanting to do that. And so China's a bit of a black box. It's tough for Western analysts to really understand what's going on the ground. I personally subscribe to a really great Substack called Sinosism, which is really a great source for at least sort of a well-informed view as to what's going on the ground there in China. But there's a lot of moving parts. But at its core, and Peter Zeihan, of course, makes this point quite loudly. Both demographically and sort of energetically, China's in a very, very tough spot.
So Wall Street and a lot of these deflationists have been saying for years, just repeating that China will keep producing cheap manufactured goods. They will keep exporting deflation. But if you actually look at the numbers over the last 20 or so years, labor costs, cheap labor costs for the factories in China, I think they're up 500% or over 500% for labor costs. So wages are up from obviously a very low base. But then on top of that, now you have these energy costs for manufacturers and factories in China, which are up enormously. So I just don't see China being able to export deflation, especially with their lockdowns, their supply chain problems, the Chinese government telling factory owners that they can't run every single day.
Yeah, again, I'd be careful about picking out any particular headlines. And as you were talking, I found the guy's name, Bill Bishop over at Sinosism, SINOCISM, runs a really great Substack and reports out, every day 7 or 8 big stories with some let's say translation of what the government mouthpieces are actually saying when they put those headlines out. But there's no question that, and look, we have friends on the ground. We were early to flagging the Shanghai COVID lockdowns and what it would mean for the global economy. The people of China are fantastic, vibrant, brilliant, hardworking, passionate, just like the rest of us. It's the leadership in the CCP that is squeezing the grip of control. And this is a fascinating thing. Of course, their ability to maintain control over their people it has certainly been enabled by technology, but also such regimes tend to collapse pretty quickly, right? And we're certainly not calling for fall of the CCP in China, but I would argue that this is sort of a metastable state, and much like how fast the sort of the Soviet Union fell apart and disintegrated into various pieces, it's not clear to us that China can avoid that over the next decade or two.
Yeah, I think they have really bad stagflation now, just like Japan, just like Germany, just like the United States. So I think all these different countries are dealing with different degrees of stagflation at this point. But the food and energy crisis and all this inflation that all these governments and central banks created the last 2 years is just created enormous distortions.
Yes.
And then you add in the bad energy policies, the ESG stuff, shutting down businesses and supply chains. The average business owner, and I've had conversations with small business owners, it's just migraine after migraine, trying to figure out new sources of supply. You get price quotes, and then all of a sudden your costs are up enormously. It's just headache after headache.
Yeah, back to the volatility point earlier, right? If you're buying coffee beans and you're selling coffee, and the price of coffee beans collapses after you secured your year-long supply, and your competitor didn't, and they're selling their coffee for half the price of what you could profitably afford to sell it for, then you're in trouble. And so, again, high prices are bad. high prices plus volatility are crippling to all businesses, farmers, coffee makers, you name it.
Well, if we had a free market, Doomberg, and politicians weren't blocking investment in new oil and natural gas supply and weren't blocking new nuclear power plants being built, high prices would cure high prices, right? Because new supply would come online, prices would come down, that would benefit consumers. But we have politicians, bureaucrats, regulators blocking capitalism and free markets from supply and demand fixing prices.
Yes, correct. And so because we have that, we have the results that you see today, and unfortunately we'll all see in the next few weeks and months, and unfortunately years ahead.
So I have one more question here, maybe outside of the stock market, although I think fertilizer companies probably long-term do have a bright future. But what are ways that listeners to this podcast can potentially either hedge or invest maybe outside the stock market in protecting their food bill from all this volatility so that they can get the protein they need or the high quality meat and vegetables or other types of nutrition that they need?
Well, I'm a bit of a prepper, one might say, which is sort of a term that some people find offensive, but I don't mind. I embrace it. I firmly believe that preparedness starts at home. And I don't trust the just-in-time supply chain inventory management of the big food companies. So simple things like literally just have enough food at home to ride out several months worth of disruptions. That alone would put you in the sort of top 2 or 3% of your peers. And unfortunately, you would very quickly have to figure out a way to secure that supply as society broke down in the worst case scenario. But I personally just physically hedge it. Very simple thing is store what you eat what you store, rotate your food, double the size of your working pantry. Maybe have some long-term food storage in Mylar bags. People will laugh at you. That's fine. They won't laugh at you when everybody needs it, but you have it. And you'll put yourself in a position to be able to help your friends and family in the case of a true emergency. I view it as insurance. The analogy I would use is imagine, I don't know, your home costs $100 a month to insure, just to pick a number. So you spend $1,200 a year to insure your home. When that year is over, you don't bemoan the fact that your house didn't burn down. It's just insurance. It's a cost, and you pay it. Why not just take $1,200 and buy some food with long-term storage potential and rotate it and increase the working capital of your home's kitchen? So preparedness starts at home. If I have a well-prepared home, then I'm better able to flexibly respond to changes in the economy. If you get laid off and you have 6 months worth of food, that's a buffer that you can dip into, sort of a savings account. You don't just need to save with money. You can save with the things you need to create a great lifestyle. Soap, and toothpaste, and shaving cream, and razors, food, and so on. You have a working capital bill for the operation of your home. Treat it like a factory. The product of your home is the well-being of your family, your children if you have them, and your spouse, and friends. And you blissfully and mindlessly pay insurance on your home. Why not pay for a little food insurance and a little bit of working capital insurance for the other consumables that make your factory run? So that's probably not the answer you were thinking, but that's my response.
Yeah, I mean, the average person's going to put in the comment section below this video on YouTube, why didn't you name any food companies I can invest in? Well, those large food companies probably are also gambling commodities futures, and they're probably also going to have losses. So they're probably also dealing with the headache of supply chain problems and this rapid fluctuation in commodities futures prices just going up and down.
Yeah, and I would say, look, I mean, you asked me what's the best way for the average listener to hedge, and my answer is hedge with physical. We started this conversation about disparity between the paper price and the physical markets. When push comes to shove, the paper price of rice or wheat is irrelevant to you if you don't have it. So my answer is store some physical.
Well, also, despite the commodities future prices getting smashed the last couple months, I mean, if you're going to a restaurant, if you're going to Costco or a grocery store right now, you're not getting lower prices from that. So the lower commodities future costs are not being passed on to the consumer right now. I'm still going out to restaurants and I'm still seeing prices go up every couple months.
No
still
question.
seeing shrinkflation. So costs maybe that were delayed over the last 12, 18, 24 months, they're still being passed on to the customer right now.
Yeah, and look, you could look at that excess working capital as both an insurance policy and a hedge against inflation. So there you go.
Yeah, and if people bought food, 2 years ago or 3 years ago, and as long as the food doesn't go bad, if they stored the food and they bought it a couple years ago, I think they're doing pretty well now if they were to go and check the prices or the portion size, the shrinkflation, because they have the food and they bought a couple years ago and they're not paying a much higher price, 20, 30, 40% higher. They're not dealing with as much shrinkflation if they would have went and bought the food right now with that just-in-time supply where they don't have any food on hand.
No doubt. And look, that's why it's really important to study it. Watch some YouTube videos so that you can rotate and like again, that expression that I use is important. Store what you eat what you store. Rotate that stuff through. Don't buy things that you don't enjoy eating. Look at the shelf life of things. Rotate them through. Increase. It's just a matter of again, looking at the operation of your dwelling as a factory where the product is the well-being of the people that reside in it that you love. And once you look at it through that lens, it's hard to unsee it. Like, hey, you have an extra $100 or $200, and you stack some food that you're going to sort of rotate into your pantry. And then if a crisis comes, the power goes out. There's the community is flooded, or there's a tornado, or pick your favorite. Electricity goes out for 2 or 3 weeks. At least you don't have that to worry about. That will compound a crisis. And so I like to say preparedness starts at home. A robust and well-fortified / supplied home is a great foundation for confidently approaching the outside world, and that's the way we like to think about it.
And people should not bet on more commodity supply coming online, because despite commodity prices that were up almost 24 months, almost 2 years since the first quarter, second quarter of 2020, we had a big run in commodities. It takes years for some of these long-term commodities projects for large oil and natural gas wells or large mines to come online. So with the crash that we've had in commodities prices, you're going to see a lot of long-term supply projects in different commodity spaces. You're going to see those projects either postponed, delayed, or canceled, depending upon what happens with commodities prices too.
Yeah, 100%. Look, I mean, it's, we're heading into uncertain times, and it's best to be prepared. So I revert back to my original answer. Start at home, work your way out.
And with the volatility and the crashing commodity prices, even volatility up and down, that's not going to bring certainty, especially with a lot of these commodity projects. If they're many billions of dollars, you need banker financing. So if you have volatility in commodities prices and a crash, you're going to have funding postponed or canceled. And then that's going to mean, and then that means that a lot of the supply growth that the market was counting on, it's not coming.
Yeah, 100%. And so it reverts back to the demand destruction scenario that we talked about earlier, which is only going to hurt the poorest and least able to respond among us. And so, look, it's not a great outcome, not a great outlook. We wish we were better, but we have to be realistic as well as we plan to navigate our way through these uncertain times.
Yeah, it's tough to be optimistic with what we're seeing in commodities and the headlines. So I wish there was cheap food. I wish there was cheap energy, but unfortunately, politicians, bureaucrats, regulators, this is a government and central bank problem. They're not allowing free market capitalism, long-term investment. They're not allowing market forces with supply and demand, because when commodity prices were high, we should have seen all that investment then into new supply coming online. We're just not seeing that. And yet we've seen commodity prices crash. I think 2 or 3 years from now, Doomberg, we're going to have very similar supply problems on a lot of these commodities.
Yeah, I hope you're wrong, but I suspect you're right.
I wish I was wrong too, but unfortunately, unless the policy decisions improve, I mean, we didn't get to discuss this, but look at all the headlines for these governments talking about windfall profits taxes on oil and natural gas companies. If you're an oil and natural gas company and your government's talking about putting a windfall profits tax on you, that doesn't exactly incentivize you to want to make long-term investments then into new supply.
Yeah, all of those factors are real, and things that we've written about and tweeted about for several months. You can't go around threatening to jail fossil fuel executives and then wonder why they aren't bailing you out of the political dilemma that you put yourself in. So yeah, it's truly amazing to see. But look, ultimately, if the economy crashes and the major recession hits, then sort of the incremental bid for a lot of these commodities does go away, and maybe the crash in the markets is signaling just that, and that's not a great outcome. All epic blow-off tops in commodities very quickly are followed by severe recessions or even depressions. let's hope that that's not what we're going into, but we shall see.
And it's also ridiculous how politicians in so many different countries are going after oil company executives, are going after gasoline station owners, who a lot of these guys don't even make profits off selling each gallon of gasoline. Maybe they make 1 or 2 cents a gallon in profits, if that. A lot of them are break even. They're going after farmers. It's absolutely ridiculous, because we've just outlined over the last 50 or so minutes, a lot of these commodity producers, especially the small business owners, the gasoline station owner, the farmers, they're not making enormous profits off the high commodity prices that have occurred the last 2 years, because they've gotten killed with their input costs, and now commodity prices have crashed.
Yeah, again, the president's tweet was idiotic. Let's just say what it was. I mean, think that the price of gasoline is set by the mom and pop gasoline retailer is just ridiculous beyond all imagination. We can only assume that they know that that's a better outcome, and they're just being cynically political. The far more frightening potential is they actually believe what they tweeted, which is not something we can begin to comprehend.
Well, I want to thank you so much for your time today, Doomberg. If my listeners want to read your excellent articles, follow you on Twitter, how do they do so?
Yeah, doomberg.substack.com. If you sign up for free, you'll get previews to all our pieces, and then hopefully we can seduce you into becoming a paid subscriber. Most of our full pieces are now fully behind the paywall. We've been paid for 3 or 4 months now. It's been a fantastic experience, blown away all of our expectations. And then we do produce a lot of original content on Twitter at DoombergT. Please be sure to check to see the number of followers. There's lots of fake and imposter accounts out there. There's only one original green chicken at DoombergT. We tweet, 20, 30 times a day, original content, charts, data analysis, threads on the weekends. Every Saturday now, we've started posting some long threads, which have gone over quite well. So those are the 2 main outlets for our content, doomberg.substack.com and at DoombergT. And Jason, always enjoy it. I'm looking forward to the next conversation, and keep up the great work.
I really appreciate that. And you had a very good thread on liquefied natural gas a couple days ago. I think it was earlier this week, on how important natural gas is. I mean, natural gas, I think, because a lot of these politicians are not approving nuclear power plants, especially in the United States. It is a nightmare just to get one nuclear power plant approved. I think for electricity generation, we're going to have to use a lot more natural gas. The demand for natural gas going forward is going to be enormous for electricity generation for the entire planet.
You bet. Yeah, these are just immovable forces, as we talked about. So yeah, it's going to be fascinating to watch.